Here's the uncomfortable truth most people never hear. Markets don't care if a policy is good. They care if it's believable. A government can announce a $1 trillion plan. A central bank can promise stability. A president can swear confidence from the podium. And markets will listen politely. Then do the math. And decide whether to trust it. That decision, quiet, invisible, ruthless, is what moves trillions of dollars every day. This matters right now because we're living through a period where confidence is being tested everywhere. Interest rates moved faster than at any point in modern history. Governments are running deficits that would have been unthinkable 20 years ago. And every major policy announcement is greeted with a strange mix of applause and suspicion. The question isn't, is this policy smart? The question is, do markets believe the people behind it know what they're doing? To understand how markets price policy confidence, we have to stop thinking like voters and start thinking like capital. Imagine you're lending money to a stranger. Not a friend. Not a family member. A stranger. You don't just ask what they want to do with the money. You ask if they can pay you back. On time. In full. Under pressure. That's how markets look at governments. When a government issues debt, it's not a speech. It's a contract. And the buyer is asking one thing. Do I trust you? This is where most people get lost, because the system doesn't shout its answers. It whispers them through prices. Interest rates are not just numbers. They're judgments. When yields fall, markets are saying, we're comfortable. When yields rise, markets are saying, convince us. Take a government bond. On paper, it's boring. Low risk. Predictable. But embedded inside that bond is a live, constantly updated opinion about policy credibility. If markets believe a government has control over inflation, spending, growth, they demand less compensation for risk. Rates stay low. Borrowing stays easy. Everything feels calm. If markets start to doubt that control, they raise the price of doubt. Higher yields. Tighter conditions. Less room for error. And here's the part nobody likes admitting. Markets don't wait for failure. They front-run it. Confidence is priced before collapse. Not after. This is why two countries can run similar deficits and get radically different outcomes. One gets patience. The other gets punished. Because markets aren't measuring numbers in isolation. They're measuring belief. Belief that inflation will come down. Belief that taxes will eventually cover spending. Belief that leaders will make unpopular choices when they have to. Once that belief cracks, prices move fast. Let's make this concrete. When the Federal Reserve signals a rate hike, markets don't wait for the hike. They adjust immediately. Yields shift. Stocks reprice. Currencies move. Not because the policy happened, but because the policy was credible. Now flip it. When a government announces stimulus without a funding plan, or promises growth without reforms, markets respond differently. Not with panic at first. With skepticism. A small rise in yields. A currency that stops strengthening. Equities that hesitate. That hesitation is confidence leaking out. And it rarely comes back quickly. There's an irony here that borders on dark humor. Politicians speak in absolutes. Markets trade in probabilities. A leader says, inflation will fall. Markets say, at what cost? A finance minister says, debt is manageable. Markets say, under which assumptions? Every policy is stress-tested against reality. Growth slows. Revenues disappoint. Voters rebel. Elections change incentives. Markets know all of this. That's why confidence isn't priced on optimism. It's priced on discipline. This is where the hidden math comes in. Debt only works if growth outruns interest costs. If borrowing costs stay below economic growth, debt feels manageable. It rolls over quietly. It fades into the background. But when interest costs rise above growth, debt stops being abstract. It becomes gravitational. Every new policy is judged against this math. Will this raise growth sustainably? Or will it add obligations faster than income? If markets believe the answer is the second one, confidence erodes, even if the policy sounds compassionate, necessary, or urgent. This is why markets sometimes react, wrong, to good news. A new spending package meant to help households can cause bond yields to spike. Not because markets hate households, but because they doubt the financing. A tax cut meant to stimulate growth can weaken a currency. Not because growth is bad, but because deficits expand faster than credibility. Markets are not moral. They're mechanical. And when confidence slips, the feedback loop turns vicious. Higher yields increase interest costs. Higher interest costs widen deficits. Wider deficits demand more borrowing. More borrowing tests confidence further. At a certain point, policy stops being about choices and starts being about constraints. That's when governments discover something uncomfortable. Markets don't negotiate. You can see this dynamic most clearly when confidence breaks suddenly. A bond market sell-off doesn't look dramatic at first. It looks like a chart drifting up. But inside that drift is a message. We're charging you more now. If policymakers respond with denial, markets respond with acceleration. This is where hype collapses into reality. Big promises collide with arithmetic. And the irony is that the loudest confidence often hides the weakest foundations. Quiet credibility looks boring. Balanced budgets. Independent institutions. Incremental reforms. No dramatic headlines. Markets love boring. What they fear is surprise. That's why countries with dull politics often borrow cheaper than countries with charismatic leaders. Stability is not exciting, but it's trusted. Zoom out, and this becomes more than a finance story. It becomes a power story. Because the ability to run deficits, stimulate economies, or absorb shocks depends on confidence. Lose it, and policy space evaporates. Keep it, and you can survive mistakes. This is why the U.S. Treasury can issue enormous amounts of debt without immediate crisis. Markets still believe, for now, that the system will self-correct. But for now is doing a lot of work in that sentence. Confidence is not permanent. It's rented. And rent comes due when credibility weakens. This is also why markets sometimes seem unfair. They forgive some countries. They punish others. Not because of ideology. Because of track records. Have you adjusted before? Did you act early or late? Did you protect institutions or politicize them? Markets remember. And here's the final twist. Once confidence is questioned, even good policy struggles to work. Rate cuts don't stimulate as expected. Fiscal spending leaks into inflation. Currency weakness amplifies pain. The tools are the same. The outcomes aren't. Because policy doesn't operate in a vacuum. It operates inside belief. So when markets price policy confidence, they're not forecasting the future. They're measuring trust in the people shaping it. And that should make us uneasy. Because trust can erode quietly. Long before headlines turn negative. Long before crises are obvious. The most dangerous moment isn't panic. It's when markets stop reacting at all, and simply demand more compensation, day after day, without drama. That's confidence draining in silence. So the real question isn't whether the next policy announcement will sound convincing. It's whether markets will believe that, when conditions worsen, and they always do, discipline will survive politics. Because once that belief is gone, no speech can bring it back. And right now, the price of that belief is moving. The only question is, who notices before it's fully repriced?